I want to be clear, I do not respect the SEC.
We made the decision in the morning to limit the buying of about 13 securities on our platform. So we're really in unprecedented times. In order to protect the firm, we had to limit buying.
That markets are efficient because of active managers setting the prices of securities. Firms like Citadel, we're all running large teams of people that are engaged in fundamental research, trying to drive the value of companies towards where we think they should be valued.
Sam Bankman-Fried and FTX, he's been charged by US courts and the SEC with money laundering, conspiracy to commit wire fraud, and securities fraud for the collapse of FTX. The former chairman of NASDAQ, Bernie Madoff, built the largest Ponzi scheme in history. Over 4 decades, he faked records of annual gains to investors who thought he was investing their funds, when in fact, he was just using new investor capital to pay off older investors.
But the synthetic shorting and naked shorting, which is illegal, market maker can execute naked shorts insofar as they're facilitating a trade. The regulators are looking at that now as to whether or not there was this naked shorting by the market makers on behalf of the hedge funds in order to facilitate the shorts, and I think they're going to uncover that there were some issues there. But the penalty for naked shorting is really not significant enough to stop it. Citadel and Goldman and all of the players get fined constantly for doing this.
Hedge funds and other Wall Street firms have teams of analysts working together to compile research and analyze shares of companies. Individual investors do not have those resources.
I basically would like to ask the SEC why they didn't act on the morning of January 28th, because I was so scared. I can't tell you how scared I was. I was so scared. I can't tell you how scared I was.
Well, Thomas, what were you scared about? What does failure look like? You said we came close to breaking. What were you scared of?
I was scared of a domino bankruptcy. I tell you, the rules require the long brokers to go into the market and buy the shares at whatever price. So that drove the shares up to $480, and then suddenly it didn't go further, but it could have gone further.
So buying and selling those 200 shares would make the market maker $1. But as millions of shares are traded, the profits from the spread add up. In 2020, these brokerages collected almost $2.6 billion in payments for stock and option orders.
These brokers, including Interactive Brokers and Robinhood, that generate revenue from selling the order flow to market makers.
Business has always been done like this on Wall Street for over 100 years.
Our orders compete against each other to get the best prices. But if the order instead is routed to a wholesaler that has agreed to pay for it, the order is not going to an exchange and is not necessarily receiving the benefit of that broader competition.
As you mentioned about commission or zero commission does not mean it's free. It does have some cost inside. Some brokers have payment for order flow.
Disclosure alone, by enhancing the disclosure around payment for order flow, really will address it. United Kingdom, Canada, Australia, all have banned payment for order flow. I know we have different markets, different systems. We even have letters that we've gotten over the years, dating back over the last 20 years, articulating why it's not good for our system. So I really ask staff to consider that, but also to consider it only in the context of the entire market structure.
On January 28th, our daily deposit requirement was 10 times more than on January 25th. As a result, Robinhood Securities imposed temporary trading restrictions on certain securities. Robinhood Securities put the restrictions in place in an effort to meet increased regulatory deposit requirements.
The decision to restrict trading really was internal to Robinhood. We did not have discussions about that. Like GameStop, AMC, all these meme stocks have brought naked short selling really to the forefront of the market's interest. This is something that's going on for a very long time in the small cap market and is very much a problem.
Has your husband ever made a stock purchase or sale based on information you've received from you?
No, absolutely not. Okay, thank you.
Those are fully collateralized tokens.
That markets are efficient because of active managers setting the prices of securities.
The order is not going to an exchange and is not necessarily receiving the benefit of that broader competition.
Welcome back, ladies and gentlemen, to Boss Blunt's Think Tank. It appears that the Office of Financial Research has come out with new data indicating that the exposure at hedge funds has skyrocketed this year by almost 25%. That is now, well, let's just put it this way. Last year it was under $23 trillion. 23 trillion. And this year, it's $28.5 trillion. You guys have seen some ridiculous things happen on the stock market. AMC, GameStop, COS, FFIE, and a number of other meme stocks and heavily shorted equities do some tremendous things already. As a matter of fact, just a couple days ago, UBS announced that they're trying to sell off their stake of Credit Suisse commercial real estate portfolios. Keep this in mind, ladies and gentlemen. We're not talking millions or even billions of dollars. We're talking about in the last 1 year, as stocks like AMC and GameStop have gone haywire, we've seen the exposure from these hedge funds go up almost 25%, from under $23 trillion to $28.5 trillion. Think about just how massive a million is, and then think of a billion, and then a trillion. It takes 1,000 millions to make 1 billion, and it takes 1,000 billions to make 1 trillion. This is ridiculous. The gross notional exposure here of these hedge funds is defined as the sum of the absolute value of long and short exposures, including those that are on their balance sheet and off their balance sheet. Look at the growth here that we're talking about. In 2018, it was $28 trillion. In 2020, it was $18 trillion. Why was it so low in 2020? Because the federal government printed trillions of dollars to give to big banks and financial industry and big corporations, and they were able to reduce their exposure from $20.5 trillion to $18.2 trillion. In 2021, June 30th of 2021, you saw that skyrocket to $24.5 trillion after AMC and GameStop both ran over 1,000%. GameStop was up, nearly $500 a share. AMC in June of 21 was up at almost $80 a share in intraday trading. As you can see here, that got crushed down to 21.9, and currently, as of the last year, basically went from 22 trillion to 28.5 trillion dollars, ladies and gentlemen. Tick tock, tick tock. That's right, Red Velvet. You got it. You got it. And again, this isn't just conjecture or conspiracy. These are actual numbers. We're going to take a quick peek at the Office of Financial Research, the Office of the Comptroller of the Currency, and the Bank for International Settlements right now. And I will show you guys all three very quickly what this should be. This video is probably going to be 15 to 20 minutes as far as the length of this live stream here. But Wall Street's lobbying and bullying and their regulatory capture has outstripped the clout of the OFR. So the Office of the Financial Research, basically all you could do is read about the potential catastrophic risks on their website and wonder when they're going to blow up and when the Fed bailout will happen. There's a reason we say on this channel, Jerome Powell, get the fucking money printer out. It's because Jerome Powell and Janet Yellen will literally have to get the proverbial money printer out and bail out the entire financial industry. Basically, the Office of Financial Research was created under the Dodd-Frank regulations back in 2010 to keep banks and market regulators informed of the growing risks. And this right here, ladies and gentlemen, look at their assets. Does it look like their assets have gone up even a fraction of what their actual exposure has gone up? Absolutely not. You don't have to be a fucking rocket scientist to see this chart and to say, there's a big problem happening here. You really don't have to be a financial analyst to know that. The Office of Financial Research here, they said, quote, leveraged hedge funds are dependent on creditors' willingness and ability to continue to lend. Further declines in collateral and their asset values can lead to margin calls that require hedge funds to tap their liquid assets. To put it in layman's terms, it means fire sales of blue chip stocks and bonds are coming. When margin calls occur, here inevitably that will happen, the largest mega banks and hedge funds on Wall Street are also allowed to own taxpayer backstopped, federally insured, and deposit-taking banks, which are the major source for providing that leverage to hedge funds. So the fact that hedge funds are exposed to this amount means that so is your fucking bank. So basically the hedge fund lending and the operations of services here at these mega banks is given the benign title of prime brokerage. So when you hear me say prime brokerage, that means banks. So the prime brokers here that are most heavily at risk, according to this report from the Bank for International Settlements, are Goldman Sachs, Morgan Stanley, JP Morgan Chase, not to mention Bank of America and UBS are right behind them in fourth and fifth. Each one of the top three that I just mentioned services over 1,000 hedge funds. Each 1,000 hedge funds. And they have exposure now to this $28.5 trillion. So what makes this even more outrageous is that every single one of these mega banks, the top five I just mentioned, has a notorious reputation for mismanaging risk in their relationships with these hedge funds in the past, as we saw with Credit Suisse and Archegos. And I'm going to delve into that as well right here. It's in these documentations as well. I'm going to show you that, guys. And a lot of you guys remember this back in 2008. During the financial crisis, Morgan Stanley owned a hedge fund called Front Point Partners. All right. And they were shorting subprime collateralized debt obligations, CDOs. You guys remember the movie, The Big Short? And these CDOs were filled with subprime residential mortgages. And basically, Front Point, the hedge fund, was hoping to profit on Americans and homeowners in America being unable to pay their mortgages and being thrown out on the street. So they're basically betting that the biggest banks on Wall Street would collapse. And in the book, The Big Short, Front Point was shorting Bank of America, UBS, Citigroup, Lehman Brothers, and more. They weren't allowed to short Morgan Stanley only because they were owned by Morgan Stanley. But if they could have, you damn know they would have done that. So again, Front Point was Morgan Stanley's own hedge fund, and they were shorting subprime and Wall Street banks. The Federal Reserve was infusing $16 trillion in secret revolving loans to these Wall Street banks, including $2 trillion in revolving loans to Morgan Stanley alone. Huge amounts of exposure uptick is absolutely astronomical. And according to the data from the Federal Reserve, Front Point received over $4 billion of Morgan Stanley's $9.3 billion loss in these TALF loans, basically. So Morgan Stanley was the second largest recipient of total Fed emergency lending programs and the number one borrower, with 43% of those funds going to Front Point. So how risky was Morgan Stanley when the Fed was flooding it with emergency lending? Basically, a financial crisis inquiry commission Where's that number here? I got it over here somewhere. The Financial Crisis Inquiry Commission reported that Lehman Brothers, when they went bankrupt, and Morgan Stanley had reached leveraged ratios of 40 to 1, guys, by the end of 2007. That means that every $40 in assets that they had, there was only $1 in capital to cover those losses. And you know what would wipe them out? A 3% drop. A 3% drop is all it would take back in 2007 to wipe out Morgan Stanley. Today, the 4 largest banks, according to the Office of the Comptroller of the Currency, quarterly report on bank trading and derivatives activities, the most recent one that just came out, hold 87.5% of the total banking industry notional amount of derivatives. Their credit exposure from derivatives increased in the first quarter of this year compared with last year's. And their net current credit exposure increased 4.6% to $251 billion. On top of the trillions of dollars we just talked about. The derivative notional amounts increased by $13.5 trillion in the first quarter of this year alone to $206.1 trillion. So hedge funds have increased their notional exposure from $22.5 to $28.5 trillion this year. And banks in the first quarter of this year increased the amount of derivatives they have by $13.6 trillion. That's not good. Okay? In case you didn't understand it, that's not good. No, literally, guys, I know you said I always thought 25% downturn would kill a hedge fund, Larry. That's not the case, my friend. Literally here, the Financial Crisis Inquiry Commission said that a 3% drop in the asset values would wipe out Morgan Stanley. And again, this is the real data, ladies and gentlemen. This is the data that's sitting out there available to you every single day. But nobody's fucking talking about this. Why aren't people talking about this? JP Morgan admitted to 5 criminal felony counts by the DOJ since 2014, and they're still allowed to grow incredibly massive in their scope and size. Back when Dodd-Frank financial regulations and reforms were occurring in 2010, they were required to relinquish their ownership in hedge funds. But JP Morgan didn't do that. They maintained their relationship with their hedge fund, Highbridge Capital, and remained a client and remained working with Jeffrey Epstein as a client for over 15 years, even though he served jail time and he was a registered sex offender. So now there's been a federal lawsuit that was settled by the Attorney General in the U.S. Virgin Islands because J.P. Morgan Chase actively participated in Epstein's sex trafficking. They literally said that there's no genuine dispute that J.P. Morgan actively participated in Epstein's sex trafficking venture from 2006 until 2019. The court found allegations that the bank allowed Epstein to use its accounts to send dozens of payments to then-known co-conspirators, and their names were redacted, who provided excessive and unusual amounts of cash to Epstein, and structured cash withdrawals so that those withdrawals would not appear suspicious. This is money laundering, ladies and gentlemen. And that went well beyond merely providing their usual banking services to Jeffrey Epstein and his affiliated entities, and were sufficient to allege active engagement directly from the DOJ. And of course, that was settled because JP Morgan knew that they were guilty of this. And we're talking about $40,000 to $80,000 withdrawals multiple times per month. Wow, that's wild. That's wild. All right, let's keep going here. I just can't believe that. At this point, I can't believe why anybody would know this and still bank with JP Morgan Chase. I'm not judging you if you do, but what the fuck? Basically, as another example, it was their Highbridge acquisition. In 2004, when Epstein's sex trafficking and abuse operation was running at full speed, he gave a bunch of money to JP Morgan. He was close friends with a billionaire who ran Highbridge Capital Management. And through the connection with Epstein, Staley arranged for JP Morgan to buy a stake in the fund and resulted in massive profits for JP Morgan. So this was profitable for everybody. It incentivized Chase to ignore the activity in Epstein's accounts and assist him in sex trafficking. So even though Epstein was not FINRA certified, he was paid more than $15 million for his role in the deal between JP Morgan Chase and Highbridge, the hedge fund. So this hedge fund trafficked young women and girls on their very own private jet from Florida to Epstein's Island in New York as recently as 2012. Check this shit out. Let's take a look at the hedge funds here from the Bank of International Settlements. The prime broker hedge fund Nexus. Recent evolution and implication for bank risks, they said. Now keep in mind, these are government watchdogs. This isn't some article. This isn't some writer or even myself who said this. This is information directly from these entities. All you got to do is pay attention. Give it 1 second here. This thing is tweaking out because this PDF file is 102 pages. So it is taking a moment to scoot it over here. But of course, I've sifted through this thing specifically to bring it to you all because knowledge is power. Look, prime brokerage is a set of services offered to hedge funds by broker-dealers, most of which are part large banking groups, right? You guys know this. U.S. registered hedge funds held over $4.5 trillion in gross assets back in the end of 2022. But let's even at the end of 2022, they had $21.9 trillion in exposure. And now their gross assets is only $9.4 trillion, and their exposure is $28.579 trillion. The amount of leverage that they're taking on and the amount of margin that they're taking on is higher than ever. And the risk to these banks, your banks, is higher than ever. That means us as taxpayers will have to pay for this through the form of federal government bailouts and bail-ins. When they print money, we will have to pay for the inflation. Same thing like you have to pay now for money being sent overseas to protect foreign borders. Money that is being printed to give people who are not citizens of this country and have come here illegally benefits and food and clothing and housing. Very luxurious at that point. But we have to pay for that. And you see that every single day when you go to the grocery store, when you pay your car insurance and your homeowner's insurance. You see that every single day. So, looking here, hedge funds attract particular attention because of their ability to ramp up leverage, which can create financial stability risks, they said. Hedge funds rely mostly on a few prime brokerages. As you guys can see here, look at this. Goldman Sachs, Morgan Stanley, JP Morgan Chase, each of which, as you can see, serve over 1,000 hedge funds each. They rely mostly on these prime brokerages. The next ones are Bank of America and UBS. Citi, BARC, Fidelity, BNP, WFC are right behind them, with a few hundred more each. Larger hedge funds tend to have relationships with PB offices, helping them to broaden their trading reach across markets. Take a look at this. I went ahead and already highlighted this stuff so you guys know what I'm reading for you here. Prime brokerage is designed to be a low-risk activity, But wrong way risk, the opaqueness of funds position, and prior risk management can create vulnerabilities for prime brokerages. Wrong way risk refers to the risk that a prime broker's credit exposure to a hedge fund increases at the same time as the likelihood of the counterparty's default. The resulting risk exposures often become apparent only when the fund is facing severe difficulties. Let that sink in. These factors played out, for example, in the Archegos capital management episode. The fund, Archegos, had large and concentrated positions in a small number of shares. Now, we all know here, because I've pulled up the receipts for you in the past, that Archegos was heavily leveraged in short positions via swaps against Gamestop and AMC stock. When these stocks suddenly, they're also talking about their long positions here as well, okay? And right now they're talking about this collateral when they say this. When these stocks suddenly plummeted their long collateral, the fund's financial strength suffered a blow, while the prime broker's exposure to Archegos surged, exacerbated by leverage. That leverage is what caused Bill Huang's bad bets through Archegos to become exposed. It caused their insolvency, their bankruptcy, and that is why he is now in prison, because he did so many things that were illegal and took so much leverage that it was complete fraud. At the same time, Credit Suisse was their prime broker. The Archegos exposure was so large that it took almost 2 years. But Credit Suisse, who was telling everybody to sell AMC, as we all know, AMC stock, AMC Theaters, is still in business, although extremely heavily shorted, and the stock price is down. They are thriving, and their revenues are fantastic, and their actual, this June, I believe it was this June of 2024, was their best June in their 103-year history. Credit Suisse, of course, is insolvent and no longer exists. However, they're insolvent and they no longer exist because of the short positions and swaps that they were holding due to the Archegos leverage. Now, this Archegos leverage that went over to Credit Suisse and made them insolvent is a legacy cost. A legacy cost is the term used in banking for a very old liability or asset, but in this term, with the word legacy cost, that is their liability. That is from a prior company. Now, the legacy that costs from Credit Suisse belong to who? The company that bought them, UBS. Now, moving on. Archegos prime brokerages were fully aware. Archegos prime brokerages were not fully aware of the size of the fund's position with other banks, thereby underestimating its overall leverage and impact on the markets in which it was active. What this means is that Archegos had hidden their leverage through the use of these swaps, and they shorted many companies and even went long many companies through swaps across multiple prime brokers. That's the fraud. Compounding these risks, Credit Suisse, the prime broker most affected by Archegos' failure, had not set sufficiently conservative terms for the leverage it had. This resulted in both an excessive credit exposure for the bank and excessive leverage of the fund. The hedge fund sector as a whole demonstrates signs of pro-cyclical leverage, wrong way risk, and opaqueness. These prime brokers tend to provide more margin loans to hedge funds when markets are high, buoyant. Secured borrowing by hedge funds correlates closely with stock market valuations. And just as leverage, you can see here in graph 2A, The independent hedge funds are quite significant players, and this is across multiple financial markets. Some of these hedge funds are spread across 6 different markets, parts of the world. It says here clearly, just as leverage in dealer balance sheets is procyclical, hedge fund credit quality, as perceived, deteriorates during weak market conditions. When the value of assets the banks holds as collateral, the fund fails. This positive correlation between default probability and net credit exposure constitutes wrong way risk. This is the important part. And look at just, it's in the middle of this fucking document on page 24 of 102, just nestled in there in a fucking word salad. And that's how they sneak it past you. This is how they sneak it past you. I'm going to read it briefly, quickly, one more time. Leverage in their balance sheets is procyclical. The quality of the credit from the hedge funds, as perceived by the broker-dealers, deteriorates during weak market conditions. And when the value of their assets that the banks hold as collateral for these funds, the fund falls, the fund fails. And the positive correlation between default probability and net credit exposure constitutes WWR. This last sentence is key. Basically, what they're saying is that the higher the default probability, the more that their exposure becomes wrong way risk. Now, let's move on to the next document here. The quarterly report on bank trading and derivatives activities, and you can see just how ridiculous this risk is. So note, we are taking 3 different financial service regulation watchdogs. The Office of the Financial Research, the Bank for International Settlements, and the Office of the Comptroller of the Currency to do our due diligence here and realize that they are telling us exactly what the fuck is going on with these hedge funds. That's why you guys have seen me play the video of Janet Yellen telling Congress that leverage with hedge funds and the shadow banking sector is the #1 greatest systemic risk to global financial structures and global financial systems. And again, I told you guys about the first quarter of 2024. 4 large commercial banks represent 87.5% of the total industry notional amounts, which is those 4 banks. I think it's $206 fucking trillion total, and those 4 banks have $187 trillion in these derivatives. Absolutely wild exposure here. Now, the actual exposure itself, they have 64.5% of the total industry net exposure. I'm going to go here to the last one because I want to tell you guys what that actually is, and then we'll come back to the top. Let's go down to the 12 of 12, and I will give you the definition, the actual definition of it. Net current credit, shit, my bad. A little lag there. Net current credit exposure. I have it highlighted here. That's the amount owed to the banks if all of the contracts were immediately liquidated. So that is the losses if all of the bilateral netting, the betting of all these contracts offsetting each other, were to occur. And it's massive. Massive. Let's check it out. This won't take long. The netting benefit, the benefit that they achieve by putting these contracts together and betting one against the other like a casino, has gone down 4.1% this quarter alone. That is very bad for banks. As you can see here, the net current credit exposure in billions of dollars has decreased significantly from 2020, but only because of the way that they've packaged it. Net current credit exposure by the counterparty type as a percentage of the total is 55.2% towards the banks as a percentage of the total. And I will show you here. Go to the next one. Again, this document is also 48 pages, so it is not easy to sift through these things. If you've learned something, please drop a like, repost. They said, remember, the Office of the Comptroller of the Currency says, collateral held against hedge fund exposures increased in the first quarter to 891.9%. Bank exposures to hedge funds are secured because banks take initial margin on transactions with hedge funds, in addition to fully securing any current credit exposure. This means they already paid up their margin. When shit fails, they will get margin called. Fire sales of assets will occur, and margin positions, in order for them to maintain their margin on their positions. If they can't, then those heavily shorted assets and equities will need to be purchased to purchased in order to return all of the assets sold, not yet purchased. And should I say securities sold, not yet purchased. If it sounds like I'm speaking Japanese, it's because they are able to sell things that they don't own. They can sell you a car without the title. And when they get margin called, all of a sudden they have to go get the title. But some guy knows that they're being margin called. Maybe multiple million people know this. And everyone's got a title, and they need billions and billions of these titles. Well, when they get margin called, they need to sell off a bunch of their assets, like Nvidia, like Amazon, like Apple. And then they got to take that money and buy the title from retail investors that hold that title at any cost. That's why you heard Thomas Peterfy, the CEO of IBKR, at the beginning of this video, say that I was scared of a domino bankruptcy. The rules say that the broker has to go out and find the shares at whatever cost. That's literally what he said. I memorized it because I've heard him say it so many times. And the fair value collateral to net current credit exposure right now is at an amount that we have not seen since the great financial crisis, since 2008. You know what? What this means, ladies and gentlemen? Well, you know what? I want to talk to you one-on-one. What does this mean? It means that short hedge funds are fucked. And so are many of the banks in the financial sector. And Jerome Powell, get the fucking money printer out. Because I want my fucking money. Janet Yellen, get the fucking money printer out. See this hat? Notice there are 2 tickers on there. Because I'm not a financial advisor and this is not financial advice and you should do your own due diligence. But there's not one, there are 2 tickers on there. And that is with good reason. Because these 2 were the largest reason for the margin call of Robinhood and many other broker-dealers, short hedge funds, family offices, Archegos, Credit Suisse, and dozens of other firms. Melvin Capital, Tiger Capital. I could go on for an hour naming them. Many of the ones that I just mentioned are completely insolvent and bankrupt, as well as FTX and Bittrex. Sam Bankman-Fried, the owner of FTX, of course, you guys know, is in federal fuck-me-in-the-ass prison. That being said, make sure you're properly hedged. We're going to be so fucking rich! Cheers. Have a good night. Thanks, everybody, for your support. I see you guys in the